The silver you're looking for might not be sold out. It might just be stuck. There's a difference between a shortage and a bottleneck, and right now, most people watching the silver market have no idea which one they're actually dealing with. If you've walked into a coin shop recently and been told they're low on inventory, or if you've noticed premiums climbing even when spot price hasn't moved much, what you're seeing isn't a conspiracy and it isn't a crash, it's a pipeline problem. And understanding the difference could be one of the most important financial lessons you take away this year. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Here's a number that might surprise you. The Silver Institute reported that global silver demand hit record levels in recent years, driven by industrial use, solar panels, electric vehicles, semiconductors, alongside investment demand. At the same time, mine supply has not grown proportionally to match that demand. On paper, that sounds like a classic setup for a shortage, but when you walk into your local precious metals dealer or browse an online shop and see out of stock on certain products, the reality behind that label is usually a lot more nuanced than simple supply and demand math. Silver exists in massive quantities around the world. It moves through a complex pipeline that includes mines, refineries, fabricators, wholesalers, and finally the retail dealers you interact with. Each one of those steps takes time. Each one involves cash flow, contracts, and processing capacity. So when demand spikes suddenly, say after a volatile week in the markets, or when spot price drops sharply and buyers rush to stack, that surge doesn't instantly translate into fully stocked shelves. What it does is strain every single link in that chain simultaneously. The refinery is one of the most overlooked bottlenecks in this whole equation. When a dealer buys scrap silver from customers, old silverware, broken jewelry, mismatched coins, that metal doesn't come back out as shiny 1-ounce rounds in a week. It has to be sent to a refinery, which assays it, melts it down, and recasts it into 0.999 fine silver bars or blanks. During high-volume periods, refineries get backed up. Processing lanes that normally take a week or two can stretch to 3, 4, even 6 weeks. And here's the critical part. The dealer often doesn't get paid for that scrap or receive usable product until that process is complete. That's cash tied up. That's inventory not moving. Meanwhile, on the buying side of the counter, walk-in customers want silver now. They're watching the news. They're seeing the volatility. They want to hold something real in their hands. The dealer is caught between a supply pipeline that moves at a refinery's pace and a customer base that wants immediate delivery. That friction shows up as empty display cases, limited SKUs, and higher premiums. It's not deception, it's math. Now let's talk specifically about which products tend to disappear first during these crunch periods, because not all silver is equal when the shelves thin out. Government-minted coins, American Silver Eagles, Canadian Maple Leafs, Britannia coins are produced by national mints on set schedules. Those mints don't ramp up production overnight just because retail demand jumped. There's a manufacturing calendar. There are die changes. There are fixed production runs. So when a wave of buyers hits the market, those coins get bought up fast. Dealers place new orders with authorized distributors, but delivery timelines extend. You end up with premiums on Eagles climbing, not because silver got more expensive at the mine, but because the available supply of finished, packaged, legal tender coins is temporarily thin relative to the number of people who want them right now. Generic rounds and bars from private mints can refill more flexibly, but even they have lead times. And when every dealer in the country is placing large orders at the same time, the private mints are also stretched. A dealer who normally gets a shipment in 5 days might wait 15. That gap is real, and it directly affects what's sitting in the case when you walk in. There's also an important distinction between scrap silver and fine silver that most buyers don't think about. Scrap silver, the kind dealers buy from the public, has real value, but it's in an unusable form. It has to be processed before it becomes product. Fine silver is already refined and ready to be fabricated. The market prices these differently, and the pipeline for each is different. During a demand surge, fine silver blanks get consumed quickly by fabricators. Scrap piles up waiting for refinery time. The dealer is holding assets on both sides of this equation, but may feel cash poor because neither is immediately liquid. That's the bottleneck in its purest form. The way you should read premium behavior during these episodes is as a live signal of pipeline stress. When premiums on Silver Eagles jump from $2 or $3 over spot to $6 or $7, that's not random. It's a dealer saying, I can get you this coin, but it's going to cost me more to source it right now, and I'm passing that cost to you. When buyback offers come in slightly below normal, that's a dealer protecting cash flow during a period of uncertainty about how long the squeeze lasts. None of this is manipulation. It's the market responding in real time to temporary friction. What this means for you as a buyer or a stacker is that timing matters in a way most people underestimate. The best time to buy silver is rarely the same day everyone else is panicking to buy silver. The premium you pay in a volatility spike can easily cost you more than any discount you captured on spot. And if you find yourself standing at a dealer counter during a crunch, seeing higher premiums and thinner selection, the right move is almost never to pay any price just to have metal in hand. Patience in that moment is a real financial strategy because what is happening around you is temporary. The pipeline will refill, and when it does, the calm buyer who waited will get more ounces for the same dollars. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. Let's go a layer deeper, because the surface explanation of "it's just a bottleneck" doesn't fully capture what's actually happening to dealer economics during these moments. And understanding this gives you a genuine edge that most retail silver buyers never develop. A coin shop or precious metals dealer operates on margins that most people would find uncomfortably thin. They're not buying at spot and selling at spot. They're buying below spot on buybacks and selling above spot on retail. The spread between those two numbers is how they cover rent, payroll, insurance, and inventory costs. Under normal conditions, that spread is predictable and manageable. But when volatility enters the equation, that spread becomes a minefield. Here's why. A dealer buys silver from a customer on Monday morning at a buyback price calculated against that morning's spot. By Thursday, when that same silver might finally be available for resale, cleaned, counted, organized, and priced, spot could have moved in either direction. If spot dropped, the dealer is now sitting on silver they overpaid for relative to the new market price. If spot spiked, they might be sitting on inventory they could sell at a premium, but now they have to make a judgment call about whether to hold or move it. Every single ounce in the case carries that uncertainty during volatile periods. This is why you'll sometimes see dealers temporarily tighten or even suspend buyback programs. It's not that they don't want your silver, it's that locking in a purchase price when you can't predict where spot will be in 72 hours is a real business risk. Some dealers hedge their exposure using futures contracts, but not all of them, and even those that do, don't always hedge every position. Smaller independent dealers are especially exposed, and this is where most people stop reading, stop watching, stop paying attention, but the ones who stay are about to understand something that could completely change how they see their money and the way silver actually functions as an asset. The thing almost nobody talks about when discussing silver availability is how much the show circuit and event calendar affects regional supply. Coin shows, PCGS events, local club shows, regional bourse floors pull significant inventory out of shops and into temporary tables for days at a time. A dealer who normally has 3 full cases of silver rounds might show up to a big regional coin show with 2 of those cases loaded into their van. Their shop, in the meantime, runs lean. Now layer a market volatility event on top of that timing, and what looks like a supply crisis at that shop is actually a scheduling coincidence. The metal is in a hotel ballroom 2 hours away. There's also the collector dimension to understand, because it interacts with the stacker world in ways that create surprising demand spikes on specific products. When a particular mint releases a limited run design, a special privy-marked coin, a colorized issue, a low mintage proof, that product can sell through in days or even hours. It has nothing to do with industrial demand or investment demand in the traditional sense. It's pure numismatic desire. But it shows up on inventory reports as product gone, and it contributes to the broader narrative of thin shelves. Meanwhile, a monster box of generic rounds sits untouched in the back because it doesn't have the right look or provenance for the collector crowd. This is also where one of the more financially costly mistakes happens, and it deserves to be said plainly. Collectors, and sometimes new stackers who don't yet know the difference, will occasionally clean silver coins. The instinct makes sense. You want the metal to look its best, especially if you're considering resale. But cleaning a coin destroys its numismatic value. A circulated 1921 Morgan dollar with original skin and honest wear might carry a solid premium over its silver melt value. That same coin cleaned with a polishing cloth or silver dip becomes a damaged coin in the eyes of any serious buyer or grader. Artificial luster is easy to spot under a loupe. The moment a coin is cleaned, it gets graded as damaged, and it loses the premium you thought you were preserving. The counterintuitive truth here is that doing nothing to a coin is often the highest value action you can take. Leave the toning, leave the natural patina. The market rewards originality in ways that feel strange to someone whose instinct is to shine things up. That same principle applies to how you store silver. Acid-free flips, proper coin tubes, and climate-controlled environments protect value far more than any cleaning routine. Now here's the data point most buyers completely miss. The premium you pay going in should always be evaluated against the premium you'll realistically receive coming out. Dealer buyback rates on common silver rounds and bars tend to run close to spot, sometimes a $0.50 above, sometimes right at it, but the retail premium you paid to acquire that same metal might have been $2, $3, or $4 over spot. That gap is your real cost of ownership, and it's not recoverable through spot price appreciation alone unless prices move significantly in your favor. When you buy at elevated premiums during a volatility spike, you're digging a deeper hole before the metal even starts working for you. The most sophisticated stackers understand this math intuitively. They accumulate during calm periods. They watch premiums the way others watch headlines, and they think about exit before they enter, which sets up everything you're about to hear in the final section. Here's the clarity you've been waiting for, and it comes down to 3 things you can actually do differently starting right now. The first is to separate spot price from total cost of ownership every single time. When you're evaluating a silver purchase, the spot price is just the starting point. The real question is, what is the premium? What does the buyback rate look like? And what is the realistic spread I'm working with? A dealer selling rounds at $2.50 over spot and buying at 0.25 over spot is giving you a 2.25 spread to overcome before you break even on appreciation. A dealer selling at $4.50 over spot during a crunch period is handing you a $4.25 spread. Those aren't the same investment, even though you're buying the same metal at roughly the same spot price. Getting specific about this math will change how you evaluate every purchase going forward. The second thing is to understand the difference between stacking and collecting before you spend $1, because the strategy for each is completely different. A stacker is accumulating metal for its melt value and its role as a monetary hedge. For a stacker, the most cost-effective products are usually generic rounds, 10-ounce bars, and common government coins bought at low premiums during quiet markets. A collector is chasing numismatic value, rarity, condition, provenance, eye appeal. For a collector, premium is expected, and the ROI comes from the collectibles market, not from spot price movement. The costly mistake is when a new buyer approaches collecting-priced product with a stacking mentality. You don't get collectible returns on a decision made with stacking logic. I want to be clear. I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The silver market, when you understand how its pipeline actually works, stops being mysterious and starts being readable. The premiums start making sense. The inventory fluctuations stop feeling like manipulation and start feeling like what they are: a physical supply chain responding to human behavior in real time. The third thing is to build a buying discipline around market conditions rather than emotional reactions. This is harder than it sounds, because the moments when you most want to buy silver, when prices feel uncertain, when the news is alarming, when everyone around you is talking about stacking, are often the worst moments to pay a premium. The fear of missing out in precious metals is expensive. Every dollar of extra premium you pay in a panic moment is $1 of return you're giving up before you even start. The practical version of this looks like this. Set a premium threshold you're willing to pay for your target products under normal conditions. Let's say you've decided you'll pay up to 2.75 over spot on American Silver Eagles in quantities of 20 or more. When premiums run above that number, as they do during volatility events, you simply don't buy. You wait, you watch, you let the pipeline refill. And when premiums normalize, which they always do, you execute. This kind of disciplined patience is not passive. It's an active strategy that protects your purchasing power. The people who lose money in silver, and yes, it happens, are usually not the ones who picked the wrong metal. They're the ones who bought at the wrong time, at the wrong premium, for the wrong reason. They walked into a shop on a Monday after a volatile Friday, paid top-of-market premiums on coins they didn't fully understand, and then watched spot drift sideways for 6 months. Their metal didn't fail them. Their timing and their premium awareness failed them. There's also something worth saying about the emotional dimension of all of this, because fear drives more bad financial decisions than almost anything else. The fear that silver might not be available, the fear that you'll miss the run, the fear that by waiting, you'll regret it. These are real feelings, and they're understandable. But the silver market has been here for thousands of years. The refinery will process the backlog. The mint will press more coins. The dealer will restock. The panic that makes shelves look empty on a Monday will resolve, quietly, without headlines, by the following month. The metal that exists doesn't disappear. It just moves more slowly through its pipeline than your anxiety wants it to. Understanding that gap between physical reality and perceived scarcity is worth more than any single purchase you'll ever make in this market. It gives you the patience to wait when others are rushing. It gives you the clarity to recognize a temporary bottleneck for what it is. And it protects your money from the single most reliable enemy of good financial decisions: urgency built on incomplete information. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.